Welcome to Beyond the Policy, the podcast where we go past the fine print and into the real stories that shape how we live, work, and protect what matters most. I'm Matt Karaffa, risk advisor, consultant, and founder of the Be Better Foundation, where each week sit down with clients, colleagues, and industry voices to talk about business, life, and the passions that drive each of us and the areas we can all work on to truly be better. This is Beyond the Policy. Welcome to Beyond the Policy. Excited to get into our conversation. Today we have Andy Younker joining us from 1859 Mutual. So Andy, thanks for taking the time. And before we get into the nuts and bolts of the conversation, maybe just who you are, what you do, and what you've been up to.
Yeah, thanks, Matt. Thanks for having me. I'm Andy Younker. I'm with 1859 Mutual. Just a guy here in Northwest Ohio that somehow got roped in the insurance industry some years ago, and now continuing to go down the road and continue down the insurance vein and see what's available and what we can do and how we continue to support the community, the people we serve, your agency, and any agencies that are out there in Ohio. Just a really wild, fun journey that insurance is.
So like most of us, you didn't plan to get into insurance. Insurance found you.
Did not plan for insurance. Insurance found me in 2008 as a student at the University of Toledo. I was at the point of my education where I needed to have an internship with a finance degree, and you couldn't really do a whole lot of internships in finance during the financial crisis. So I found something financial adjacent that was insurance. Started off as an intern with a company called Woodville Mutual, which became 1859 Mutual. Started as an intern, was offered some part-time work to go through the next semester, graduated, was offered full-time work, and here we are 18 years later, still doing this thing.
Yeah. And we'll get into some of the details of the ups and downs of the industry that we've been through recently and what that's looked like. But most of the guests that we've chatted on, have been wide-ranging from business owners, so we haven't had a whole lot of specific professionals inside the insurance space on, so excited to get into that of more kind of taking your knowledge and, hearing from the company itself. Sometimes people get sick of me telling them, hey, your rates are going up because X and Y, when I'm most of the time relaying information I'm hearing from you and other companies we represent. So excited to get your perspective on, how it pertains to your company and all that. So if we take a holistic view of the last 5 years, kind of hard to do, but if you had to summarize the last 5 years from an insurance company standpoint, from your background, what would you do?
The last 5 years were definitely some of the most trying we had. I think some words that come to mind, volatile, definitely a humbling experience, and maybe most importantly where we're at now is it was corrective. There's a lot of things that happened in the last 5 years that really were kind of the catalyst to change, and I think that what we really need to grasp in the last 5 years is insurance has its fundamentals. It's been around for a long time. It's been around since the 1600s, and Lloyd's Coffee House and Lloyd's of London, if you've heard of that. So there's a lot of history there. There's some definite insurance fundamentals that have been established over that 500-year history that we've almost got going on here, and we've got to stick to those fundamentals, and that's really kind of what we saw happen in the last 5 years was a correction to get back to where we have come from and what we know how to do and how we do it. 1859 Mutual is got that name for a reason. We were founded in 1859, so we just kind of had to go back to some of the things we were already doing and just make sure we were definitive in sticking with it. So it was definitely a realization that there's an insurance cycle. And that cycle is always evolving, whether you realize it or not. It's something that we have to be very aware of.
Yeah, and before getting deeper, just give a brief overview, 1859, what you specialize in, what type of policies and clients you have as a mutual company.
Yeah. So we are an Ohio-only, primarily home writer. So we just write homes in the state of Ohio. And that is our specialty. It's kind of our force specialty, but it's what we like. So we just like to be in Ohio. We just like homes. We don't have any appetite outside of that, primarily because we can't have any appetite outside of that.
Yeah. And when we get into, a lot of things that I hear, and probably you do too, is, my home insurance went up X amount of dollars, But I talked to my neighbors, and their house went down, and that gets into the underwriting of all the different factors that go into it. You know, you can have the clients look at the same house and get two different prices based on all the new underwriting factors that go into it. So kind of digging into that a little bit about in those 5 years, specifically on the underwriting stage, what changes have you seen for better or for worse?
There's been a myriad of changes, but as I kind of mentioned, is a lot of it just went back to fundamentals. Yes, there's a lot more criteria that went in. People were looking at, there's a lot more data that's available. Obviously, with more technology, more data points. Insurance is relying upon those to help do some predictive analytics to figure out, you know, what the particular best type of risk is. But at the end of the day, it's a risk game. You know, there's losses that have to be paid, and there's going to be a price that's set for the expected risk that there is. If you ever want to know, you know, how much your house should be insured for, you think it's bad, just go over to your neighbor and ask them and say, hey, I want you to cover my house if anything goes wrong next year, you know, anything at all. You're going to come pay for it and fix it. And how much do you think your neighbor would charge you if you were to do it? So, you know, insurance is a pooling of a lot of people's same types of exposure, and that's how you're able to get that rate down, because I'm assuming that your neighbor would probably say a number a lot higher than what you're going to pay for an insurance premium.
Absolutely. And that's the thing of people that aren't in it every day like you and I, you know, getting that message, a change when they've been traditionally buying insurance a set way for a lot of years, and then you add in losses, underwriting changes, you add all those things that happen in a short period of time. And it just, you know, managing through what I would say the new normal is when it comes to that.
Yeah, and you know, there's a lot of changes, and if we talk about the last 5 years in particular, I think one of the things that really happened and what kind of, I'd say, was the biggest driver in all of this was the inflationary environment. And this inflationary environment doesn't seem like it's a problem, and what happened and why it all caught up to everyone at once is the way insurance rates work. Insurance rates work by taking and looking retrospectively at what loss histories have been and costs have been historically, and then making a prediction based upon those historical events, and then sending a rate. So we set that rate, you know, we're taking a look at the historical of it. When you get inflation going on, that's based on a rate that was set on past information. Now you've got future inflation, you're paying losses at current rate and market rate. That all compounds, and that widens that gap. So then it also takes a little bit longer for rate changes to go into effect, and then they put a load on top of that to say, okay, we got to expect this to go on a little bit further. That's when we saw these big numbers coming out that everyone got upset about, and all of a sudden, oh my gosh, rates are going up 30, 50, 100%, whatever it may have been, depending on the particular situation. And it was really a reaction to the fact that the losses were being paid at today's rate based upon prior values, and that gap had to be picked up, and there was a really short window in which that gap had to be picked up. Hopefully, I think today we sit in a little bit better situation to where most companies have done that, but if a lot of companies haven't taken that corrective action, you know, we saw some that didn't, and unfortunately that meant a different type of contraction in the market because those companies are no longer in business. So now you've got, you know, less policies, options, and capacities out there for people to choose from by losing these companies that weren't able to make corrective actions fast enough.
Yeah, very good point. And I think with a lot of that inflationary caused all companies, you included, to react and do things that made sense for your business. And every insurance company out there kind of made those decisions that worked for them as a whole. What do you think in that period? Do you think the industry got right and we're going in a positive direction that will eventually, you know, help the client, the policyholder, versus what do you think maybe we were a little too reactionary and maybe went the other way?
You know, the things that we got right is we went back to the fundamentals. Okay, there was some things that were going on that, you know, underwriting is pretty much maneuvering through the gray, right? Underwriting that's very black and white, but there's a lot of gray, and so when companies get out underwriting in the gray, it creates a lot of opportunity for policyholders and agents to find capacity where that might have not been traditionally, that might not have fit with the company underwriting appetite, but because the market was relatively soft, things were being placed out there into the gray areas. So we saw that get cleaned up, and you know, markets be able to more traditionally price and rate based upon the actual risk appetites that they have. So that was a very good thing that came about. It really kind of defines things, makes it more clear, makes more definitive risk profiles, which in the long run helps everyone out. I do think that there was a bit of an overreaction in some of the constraining that was done and the restricting of policies. Maybe some of it was warranted based upon individual company experience, but some of it I think could have been a little bit of overreach. But I think that that's going to shuffle itself out. I think that thankfully the insurance is a free marketplace. Even though we are regulated, we are primarily a free marketplace. Mm-hmm. So if consumers and the public doesn't necessarily like those actions, the company's going to have to pay the consequences of whatever that decision that they made is. So I'm hopeful that any of these overreaches that there might have been a little bit. I know that there was some companies that they might have said took rates a little bit too far, but that's going to depend on their individual positions. I can't speak to that as a whole.
Right.
In general, I think that most companies did what was necessary and didn't try to be egregious, but I can't speak for everyone.
Yeah. And I think one thing to echo what you just said is, constrict it to be more black and white for probably the last 2 to 3 year period. And now I'd say we're at the very early stages of, not to say we'll go back to the gray area that was, but getting back to fundamentals established. You got a base, and now you can be more selective going forward, knowing you need to grow and put business on the books and write the right policy. But I think that kind of reset is what you're getting at of set the trajectory going forward a little better.
Reset, know where everyone's expectations are, know what the appetites of the companies are, what type of risk belong with what type of policy, what type of carrier, all the different risk attributes being classified and properly placed in the order that they belong. I think that's the big thing, and that's what we're going to benefit from going forward, because things might have just been placed a little erroneously or haphazardly in times past. And yes, we are seeing the beginning of that softening of the market, but I think that in these early stages, if something large were to happen, we could easily revert back into that hard market pretty quickly.
Sure.
Where we're at.
Yeah. And then getting into one topic, which, you and I have had conversations with, I get on a daily basis of, why is my rate so high? It goes back to pricing at some way, shape, or form, but through what we've talked about, why you buy insurance is to cover bad stuff from happening. Yeah. And when those dollars get increased for, replacing houses and roofs and, small fires, that has a cost that went up, that is arbitrary, then passed on to the policyholder. So if you were to educate someone buying insurance who doesn't live in it like we do day to day, what would you or how would you explain to them, yes, it did go up, but it was for X, Y, and Z?
Yeah, I think the biggest things of the most recent, we've already kind of touched on, is that inflationary environment. And that inflationary environment had an impact on loss cost, and that loss cost was now driven up. And that loss cost is directly impacting how you're rated. That's one. And some other things that have been happening, and these kind of just add a little bit more flavor to what's been going on, but aren't necessarily, I think, as large of factors, but they were contributory. We had these nuclear verdicts that are still continuing to happen today, from, people going out and suing one another, and if we were to expect $1 million outcome, or even if the lawsuit said we request $1 million in relief for this, and then the jury comes back as a say, hey, but here's $100 million, that's problematic. And these, even if they don't get the $100 million, the insurance company has to be involved in fighting to get this new outcome. So that's costing money. All of that cost of is adding to the loss cost, which is increasing the policy. And then to get into a little bit, more nuanced side of things, reinsurance capacity is another thing. And so reinsurance is insurance on insurance, for those of you that might not be aware, but it's also what provides smaller companies like myself to have the ability to write larger styles of risk, because we're able to then reinsure the risk that we are with a larger carrier and spread the risk out that we have. So that capacity, our cost of reinsurance increased. So when that cost increased, that cost then gets passed on to the policyholder. So, to say it was a perfect storm is probably what a lot of people would say. It would be pretty in vogue to be that way. Really, to me, it's all contributed from this inflationary environment, and that trickled down into all these different areas that we're going to speak of here, and really made an impact on individual policy premiums. the last thing that you can say, but is the increase of cost of storms, secondary perils being a pickup. Secondary perils in the industry is what we consider severe convective storm. That's another word that's not really used by laymen. We call it thunderstorms for the most part, thunderstorms and tornadoes. Those were considered secondary perils by the insurance industry. Those secondary perils are now primary loss drivers. And really, it's that inflationary environment. What it would cost to replace your roof after it got ripped off by a thunderstorm? If it was, X pre-inflationary environment, it was now X times 1.5, X times 2 in the post-inflationary environment. So that just automatically increased that loss cost again. So this all kind of bubbled up at once and really caused this last 5-6 years to be an interesting time.
Yeah. And with, I think, for the most part, that reset happening, if we flip it, we looked at 5 years back, now let's look 5 years going forward, take it from either the company standpoint, the agent standpoint, or for the policyholder standpoint, forward-looking 5 years, what are some things to expect or that we could plan for going forward?
Yeah, the next 5 years, it's hard to predict, but I think some of the goals that we'd like to see in the insurance industry is just more efficiency in how insurance works, from the insured's experience as a purchase of insurance to how claims are handled and settled and paid. There's a lot of room and opportunity to utilize technology, data, AI to better involve these things to make for a more fluid, seamless experience. I have no idea what's going to happen with the weather, so I'm not going to speak on rates or anything like that, or how the market's going to act, because I've got no clue. If you could tell me, that would be great. We'll get together with me another time. We'll go out and learn how to make a lot of money together. But I can't really do that. But I think that if we can help incorporate all these things, and then know at the essence, insurance is a people business. When it comes to the agent-carrier relationship, the agent-insured relationship, from my side, the carrier-reinsurer relationships, there's a lot of different relationships that work there, and we know this is a people business. And as long as we maintain and understand that this is a people-first business and help use these things to better foment, make this a better place for all of us to work in, I think it'll really help the next 5 years. And I really think that there's a lot of technology and AI that can help drive this, as long as we remember it can't take over. It's just got to be a helpful guiding hand to let us go forward.
Yeah, and you bring up, I've been, talking about AI in different industries, and, as it relates specifically to insurance, you've hit on what I've been saying. It's not going to replace insurance agents, insurance companies. It just can't. There's too many decisions that aren't there yet. Not saying it won't ever. But in your specific industry on a day-to-day, where have you seen AI or technology from the carrier side kind of help or speed things up?
Yeah, the data collection, right? So in underwriting and data collection, and what we can do to get the data that we need to underwrite a policy, how we go about it, the resources we go to, that is a lot faster than it's ever been. So that's going to create efficiency. If we can speed up our time to underwriting, that can reduce our underwriting costs, which can create efficiency to help be passed on to the insured. So that's one that we're seeing immediately. We're currently piloting some work on our claim side to help with reducing our time to get claims paid, how we can have a better claims experience for the insured. So there is a lot of use of technology to help amplify what we already do. Not to replace anything that we're doing, but to just help better support and amplify what we're
and I think that's not just insurance. I think that's a lot of industry figuring out how to utilize it and help be more efficient when it comes down to. So I'm sure there'll be a lot more to come and changes by the week.
Yeah, no, it's never-ending changes. That's what we deal with in the industry. That's for sure.
Yeah, and if we dig into a little bit on the education of insurance, if you had a magic wand and could have all of your agents do one thing better or not as bad as they've done in the past, what would help, you think, manage that agent to client perspective and doing business with you, the carrier, a little easier?
I think the biggest education piece is, one, the consumer needs to be better educated on a policy of insurance. I think that that's key. Consumers' expectations, I think, is really what needs to be looked at and talked about. Is, what is your expectation if this policy needs to be used? That could really become an issue come time of loss. Some people, we don't really have education for insurance at the primary level in schools anymore. So some people will think that it's a maintenance policy and it's here to, hey, something went wrong, I need this taken care of. And it's like, well, it wore out, or, this is something that isn't covered by insurance. And that piece isn't being relayed to the insured, and it's not necessarily always the fault of the agent, not necessarily the fault of the carrier. It's just it's a lapse of knowledge that we have that I think could be better filled. So I think that the best thing we could do is make sure that the expectations of all parts of the food chain there are clearly laid out. Not necessarily wait until something goes bad and now all of a sudden, hey, this is going to be a problem.
Yeah, I have a lot of conversations with people of just think anything bad that can happen should be covered by insurance.
Right.
Which, in theory, if they're educated and you say, yes, these bad things that are listed here are covered.
Yeah.
And spend time going over, more importantly, if these things happen, they are not covered and they are specifically excluded because of, and there's that list too.
Yeah, and I think, we can oversimplify this a bit too to help people have a better understanding. One of the things that I was taught very early in my insurance career is, there's two elements that you need to have for any insurance claim, let alone the exclusions or anything else. But the only two things you really need to know is this sudden? Did it happen suddenly? And was it accidental? As long as it's sudden and accidental, we've got two elements that we're going to have no matter what the insurance claim is. It didn't happen over time, so we know that it all of a sudden something broke, and I didn't do it on purpose. There was no willful intent to do it. We got those two things. All right, let's start talking about when things start to wear out, when things just, I just need a new one because it's time. Well, that's going to be sad if you turn that in. You think that's a claim because it's not going to be covered typically. So that's one of the things that I think we could really do to help people to just have that little bit of knowledge. Sudden and accidental. Those are two things we got to have in order to be able to turn it into a claim. If we don't have that, we probably don't need to go much further.
Right, and that's educating. I think just goes a long way on like everything you mentioned of. It helps improve the process of because we're talking about something that the end buyer of this hopes they never have to use it.
That's right.
So it's not a daily occurrence. It's not driving your car every day. It's not something you're used to, and you have this many changes in the years that we talked about.
People don't call me to tell me that they're having a good day.
You too. You get those phone calls too. Yeah. You don't get a lot of calls up saying, "Hey, this really great thing happened, and by the way, my basement has 2 feet of water in it."
You just hope the basement had 2 feet of water in it. That's a relatively innocuous one after you've been in the industry for a while. You get the phone calls of these people no longer have anywhere to live, or they lost someone near and dear to them. I mean, these things are very tragic, and I mean that's one of the very difficult things about insurance is you are dealing with the doom and gloom.
Yeah. Any specific stories stick out to you? Obviously, when you are at the end of the day, when claims do come through, you're in the business of paying claims that are documented through the insurance. Any claim scenarios that stick up that was a learning experience, good or bad? In your career?
Every one of them is a learning experience. I think that one of the things that I've learned over the years that's really helped guide me now is, the insurance policy itself is a contract. And the contract can't preempt and know what is going to happen at time of loss. And unfortunately, contracts are very rigid. So we have to take this situation that's very tragic to someone and has taken on a life and shape of its own, and we have to somehow shove it into the insurance policy within the four walls of the contract and then shake out and get this financial relief for these people. And most of the times we get through without a lot of issue because we've seen similar types of situations before. Mm-hmm. But we can get into some very unique situations that don't always shake out the way that things in ways that people want them to, and it's that contractual nature of the insurance policy that just makes it seem so impersonal at times. And I think that that's one of the biggest things that we strive for is to make sure that we know we're dealing with a contract that doesn't have emotion. It's not a person or anything else, and know that we need to help these people in any way, shape, or form to say, this is what the policy has provided for you. This policy couldn't know that this situation was going to happen to you in the way it did, but we're going to do the best we can to support you with what's available here for you.
Yeah. And that's a very tough thing to do because not every claim is the same. It's always going to have a different nuance that is not very to the T spelled out in that contract. So I think that's a good takeaway. Anything else from whether to the agent side or to the policyholder of just the general information? My motto is be better. So how can we be better agents? How can we be better purchasers of our insurance when it comes, from the company side? Any advice?
Yeah, I mean, the biggest advice is, insurance is a people relationship. So as a policyholder, seek a trusted advisor. As an agent, be a trusted advisor. Do what you can to help educate these people on the particular types of risks that they might have, their exposures, what they need to purchase, what they may want to consider purchasing, and what might be overkill. You can, a lot of people say you can go insurance poor buying too much insurance. You definitely can, but there's a certain level of risk that you need to be willing to take as a policyholder on your own. There's a certain level of comfort that the agent's going to have selling you to that level of risk. So there's a relationship that's involved here, and that really can't be discounted. And the biggest thing that I see that it pains me when it happens to people is they purchase on price. And if you purchase on price, chances are, you've all heard the saying, you get what you pay for, and you don't want to get what you pay for if you've been underinsured, and that's how you got the price down and something tragic happens. Because your insurance is the transfer of financial risk at time of pure loss. And if you only transferred a portion of it and you've lost everything, you're only going to get a portion back, and that's a problem. And that's the biggest concern that I have, and biggest takeaway I have for anyone is, know what you're buying. Make sure you're adequately insured. Yes, you can be overinsured, but you certainly don't want to deal with the consequences of being underinsured.
A couple things you brought up of at the time of loss. Speaking of the overinsured, to my knowledge, no one says, no, Mr. Insurance Company, you've given me too much money. I want to give you some back.
I have had it happen once in my career.
Once? Okay, so it does happen.
It does happen.
But on the flip side of that, to your point of, you don't want to be insurance poor, but on the most times when we're talking price to increase an extra 50 or 100,000 of coverage, we're talking a few $100s.
Right.
From a premium standpoint. So it's not... And you were to ask someone at the time of a loss, if I would give you $500 for the chance for you to get $300,000, you would probably pay that every year.
Right. Yeah, and that's to make sure that you're adequately insured is inexpensive. If you have insurance, you've already gone through the most expensive portion of it, which is the cost of acquisition. Now to maintain it and make sure it's constantly up to the adequate values that you have today, that's relatively inexpensive. Yes, it's going to go up every year. There's going to be inflation. There's these things that are going to continue to grow. You're probably going to continue to grow in your exposures as a person. So these things are going to
constantly
go with you.
Change, yeah.
They're going to constantly and follow you. But once you've made that initial purchase, the additional enhancements typically aren't that much more to do.
Right. Yeah. So there you have it. If anything through this episode you have questions on, feedback, we'd love to hear it. But thanks for tuning in to this episode of Beyond the Policy, and we'll catch you on the next one. Thanks for hanging out with me on Beyond the Policy. If you got something out of today's conversation, pass it along to a friend, client, or colleague who might enjoy it too. You can always connect with me through the show notes or on LinkedIn. And remember, the best coverage always starts with the right conversations. Until next time, be better.